How's everybody doing today? This is Bob Iacchino from Path Trading Partners. Thanks again for being here. Thanks to Nadex for hosting this as always, and let's go ahead and get started. This is Nadex Spreads, Understanding Nadex Spreads. This is class number 3. We've done 2 prior to this, and they are on Nadex's brand new fancy website. If you haven't seen it, you can go to nadex.com. and you can see all of the archived webinars under a tab listed right along the top where it says webinars. You drop down that webinar, under webinars, you drop down that and you'll see archived webinars that are under Learning Center. You go in the drop down arrow under Learning Center and you'll see webinar archives. You'll be able to see class 1 and 2 there if you need to. But in the meantime, let's do a quick risk disclaimer. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Notice we call this a risk statement, not a risk disclaimer. Please take this stuff very, very seriously. This is not like fantasy football for money. This is real trading. Nadex products are real. And even though you have limited risk, you still have risk. So you should always understand that going in. You should never exceed the amount that you can lose or that you can stomach the losses of in any type of trading. And that includes Nadex products. So we take this very seriously. That's why we read this at every webinar that we give for Nadex. Who is Path Trading Partners? We are a trading and education firm. Our mission was to form a firm that educates, supports, and backs traders with seed capital who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. We are a firm that believes in a long-term success in trading covering time frames dictated to us by products, markets, and price action. We mention that because, again, I've repeated this in other webinars, and I just feel a strong need to say that again. To try and dictate what you want to happen on the markets is futile. So it's very much about learning a particular method and letting the market either give you trades or show you that you should stay out of trades. We always talk about it's much more important for traders to learn the trades that they should stay out of than the ones that they should actually get into. And so you can live to trade another day. Mike Arnold is here. He's a 24-plus year market veteran. He's been teaching traders online and in person for 10-plus years. He was and still is a strategy and development consultant to multiple hedge funds. We've talked about this before. Mike's job when a hedge fund calls him to consult, they have come up with an algorithm or a strategy, and they ask him to find the problems with it. Makes him a joy to talk to on a daily basis, I'll tell you that much. Former options market maker on multiple exchanges. Mike has traded in Chicago, New York, Switzerland, and Canada, and he is the current head of technology and trading system development for Path Trading Partners. Mike is the ultimate devil's advocate. This is me at the top. I've spent the last 24 years in the commodities, futures, and forex markets, and I've been teaching traders both live and online since about 2002. I have had pretty much every job there is in this industry in my 24-plus years. I've been an analyst, a prop trader, I still do trade, a fund of hedge funds principal, member of the investment committee, and I have taught and mentored over 5,000 students to this stage. I appear on all the major networks. I don't really care too much about that, but if you care about it, Bloomberg Television tomorrow, I think it's 7:20 a.m. is the next time I'm scheduled to be on, so you can catch me on that. To date, I've done over 700 interviews on various economic, political, and market-based topics. I continue to appear about 5 to 10 times per month. That makes it real fun for Mike to talk to me, because I'm like a TV star, I guess. That's ridiculous. Anyway, so let's do a quick prior class review. In the prior class, we've examined the concept of how a Nadex spread is really either a call debit spread or a put debit spread, depending on the direction of the trade. These vertical spreads are constructed by being long one call or put and short another call or put at a different strike price. Obviously the same ones, 2 calls or 2 puts. We examine the risk graphs as they appear at expiration. So let's take a quick look at that. And again, to go into detail on these, you'd want to go look at Lecture 2, again on that Nadex tab, and I'll show you that at the end of the lecture here. Essentially what you're looking at is a long call in terms of a vertical debit call spread, bull call spread. You're looking at long a lower strike call added together with short an upper strike call. So if you were long this particular call, the middle line represents the profitability of the position, and then the horizontal line, the vertical line represents the underlying price, whether it's moving lower or higher on both of these graphs. So essentially, the second that you buy a call, you're in a loss position because you have money out there. You've paid money for it. So you need the underlying to go slightly above the break-even point, which is in the middle, to get you to break even to cover the cost that you paid. And then as the market continues to go higher, the underlying market, your position goes into profitability. Remember, the half of the scale here is the gain or the loss of the position on the vertical axis. The horizontal axis is the price of the underlying, whether it's going lower or higher. Opposite is true for the short upper strike call. So you would go short, so you would collect premium in traditional options. So you'd collect some premium, so you're immediately in a gain situation. And if the market were to go higher, you have unlimited losses on this particular position. You have limited losses on the long lower strike call and unlimited losses on the short upper strike call. Your gain is limited to the premium that you collected, and your gain here is unlimited. So when you add these two together, you end up with a limited loss and a limited gain. Okay, the yellow line here represents the continuation of these two positions if you were to have them in separate accounts individually. But once you combine them as a vertical debit bull call spread, this is what your risk graph looks like. You start to gain money as the underlying goes higher. Again, you're long the lower strike. The underlying goes higher. You get to break even, and then it continues. And then as you get to the upper strike call, your profit is capped. In options, there's something called option moneyness, and this is still a review of last week. In the option world, there is a concept called moneyness. Moneyness is the relative position of the underlying with respect to the strike price of an option. Something that's forgotten a lot is that Nadex products, binaries and spreads, are options. And as we mentioned, these are vertical debit spreads. Nadex spreads are option vertical debit spreads. So moneyness is the relative position of the underlying with respect to the strike price of the option. Since Nadex spreads are a form of vertical option spreads, they also have the concept of moneyness. So let's look at Nadex spread moneyness. There are three main categories of moneyness: out of the money, or OTM, at the money, or ATM, in the money, or ITM. There's also the concept of deep in the money and deep out of the money, which are just modifiers of the in the money and out of the money concepts. So let's take a look at what out of the money looks like. We refer to a Nadex spread being out of the money when the price of the underlying is below the floor price when trading a spread long. Conversely, if the price of the underlying is above the ceiling price when trading the spread short, it is also out of the money. So here's an example visually. If the US 500 is trading anywhere below the floor price of 1900 in this particular example, the 1900 to 1940 415 Eastern Time expiration, okay? And the expiration doesn't matter for the out of the money concept, but 1900 to 1400, if the US 500 is trading anywhere below the floor price, okay, so from 1899 on, the spread is considered to be out of the money. It's very important you understand these concepts. They're simple, but they feel complicated when you first start to grapple with them. Conversely, the short spread. If the US 500 is trading anywhere above the ceiling price of 1940, then the spread is considered out of the money again. So again, here we have it reversed because this is the risk graph. Okay, this isn't One number is greater than another. This is the way the risk graph would look. So the ceiling price is here, and if the US 500 is trading at or above 1940.1, it is considered out of the money in the 1900 to the 1940 spread if you're trading that spread short. Okay, again, extremely important you know this concept, and it is actually very simple. All you have to do is think, if we expired right this second, would I make money or not? If you would not make money because of the price of the underlying, forget what you may have paid for the option, just where the price is in relation to the strike prices on the spread. Then you easily can see whether it's out of the money or not. Deep out of the money, as we said, is just a modifier. If the price of the underlying is trading way below the floor price for a long spread, it can be referred to as deep out of the money, and that's used a lot in options. For example, if the US 500 is trading at 1850, floor price is 1900, then the long spread is deep out of the money. Just means it's very far away. If the price of the underlying is trading way above the ceiling price for a short spread, it can also be referred to as deep out of the money. For example, if the US 500 is trading at 1980 and the ceiling price is 1940, then the short spread is deep out of the money. Okay, again, it just means it's really far away. These concepts, again, are simple, but they sound really complicated when we use them in conversation if you've never been introduced to them before. Let's talk about at the money. We refer to a Nadex spread being at the money when the price of the underlying is trading at the floor price when trading the spread long. When it's trading at the floor price, that's at the money. Conversely, if the price of the underlying is trading at the ceiling price when trading the spread short, it is also at the money. So here's your example. Again, long, you're looking to trade long, 1900 to 1940 Nadex spread. If the US 500 is trading at the floor price of 1900, it's trading at exactly 1900, then it's considered at the money. Conversely, again, remember, this is the risk graph, not just one number is greater than the other, so it should be higher in the picture. That's not the way it works. Okay? Floor price is 1900, ceiling price is 1940, looking to trade it short. If the US 500 is trading at the ceiling price of 1940, then the spread is considered to be at the money. Okay, it means one tick down and you're in the money, which we'll cover right now. So let's talk about in the money. Can you guess what this means? I bet you can. We refer to a Nadex spread being in the money when the price of the underlying is trading above the floor price when trading the spread long. Conversely, if the price of the underlying is trading below the ceiling price when trading the spread short, it is also in the money. So let's take a look at a visual example. Look where the green is. If the US 500 is trading above the floor price of 1900 in this particular 1900 to 1940 spread, then the spread is considered in the money. So the second it trades 1901 on a long, remember being long or short matters as to whether these are in the money, out of the money, or at the money. The second that it trades above 1900, it is in the money. And it stays in the money as long as it stays above it, no matter how high it goes. Now a short position, same spread, 1900 to 1940. If the US 500 is trading below the ceiling price of 1940, then the spread is considered in the money. Okay, so same thing. As long as it's below the ceiling price of 1940, then that means at expiration it has value. So it's in the money. Any of these levels here. So you can probably figure out what deep in the money means. If the price of the underlying is trading way above the ceiling price for a long spread, it can be referred to as deep in the money. For example, if the US 500 is trading at 1980 and the ceiling is 1940, the long spread is deep in the money. If the price of the underlying is trading way below the floor price for a short spread, it can be referred to as deep in the money. That would be the short side. For example, if the US 500 is trading at 1870 and the floor price is 1900, the short spread is deep in the money. You hear those conversations every day between option traders. I'm looking at deep in the money calls or deep in the money call spreads or put spreads. That's what they mean by that. It's just very far away. So why is moneyness important? Well, moneyness is important for two major reasons. The first reason is to understand spread premium and what contributes to the premium paid for a Nadex spread. The second is so that when you are learning different strategies, you're understanding which spreads would be appropriate to trade. If we say that you should be looking to short a crude oil spread at the money when crude is trading at 45, then you know exactly what to look for. You're going to be looking for a 45.50, whether it be the floor or the ceiling, depending on whether you're long or short. That would be the at-the-money crude spread. So it assists you in the development of strategies. Let's talk about premium real quick before I turn it over to Mike. Up to this point, we haven't really discussed the concept of premium. If you've traded options or Nadex spreads, then you have realized that you generally don't get to put them on for free. A little sarcasm there. It's not like trading the underlying where you pay a transaction cost, but other than that, you are paying what the underlying is trading at the moment. Okay, that's what premium is. Let me turn it over to Mike now. I'll take care of the rest of this for you, and I will talk to you guys in a little bit.
Great, thanks, Bob. So let's continue down this concept of premium. Options and Nadex spreads. There are two components that make up the premium for options and Nadex spreads. These two components are intrinsic and extrinsic. So if any of you guys already know or understand options, you might already understand the concept of intrinsic and extrinsic value. Well, since Nadex spreads are made up of options, as Bob reviewed and we went over in last week's webinar, Nadex spreads also have intrinsic and extrinsic value. So intrinsic value is essentially the value at expiration. All right, so if we're along a spread and it expires below the floor, its intrinsic value would be 0. If it expires above the ceiling price, it would be the full value of that spread. If it expires somewhere in the middle, then it will be whatever was above the floor. That would be the intrinsic value if you're long. Extrinsic value is the time value. All right, extrinsic value is the premium of the spread. And one thing, extrinsic value can be positive or negative when we're dealing with Nadex spreads. Intrinsic value is always a positive number. Extrinsic value can be positive or negative. So intrinsic value for a long spread is calculated by determining how much the underlying is above the floor price of the spread. If the underlying is not trading above the floor, then the long spread does not have any intrinsic value. Really simple. It has no value. It's out of the money. Anything that's out of the money has no intrinsic value. The maximum intrinsic value is capped by the ceiling price. So the maximum intrinsic value is always the difference between the floor and the ceiling price. For example, when the US 500 is trading at 1970, a US 500 1955-1985 spread has an intrinsic value of 15. Why? Because the underlying is trading at 1970, the floor is 1955. All right, if we're long this spread, let's pretend we're long this spread, then it would be 1970 minus 1955, which would be a value of 15. That's intrinsically what it is trading at. The maximum intrinsic value of the spread would be 30. Again, how do you get that? You subtract the floor from the ceiling price. 1955 subtracted from 1985 is a value of 30. So here's it shown graphically. We're long a spread. We're trading at 1970. Intrinsically, it's worth $15. Now, that spread might not be trading exactly at that money. You might be paying more or less than the intrinsic value prior to expiration. This happens to be right in the middle. So as something we'll get into, this is called the null point, and that's where it essentially is trading at full intrinsic value and extrinsic value is 0 when the spread is in the money. However, other places, let's say we were trading at 1960. So we're trading at $5 above the floor price. So the underlying is trading 1960. Intrinsically, it would be worth $5. However, if you put this on maybe with hour and a half until expiration, you are not going to pay $5. You are going to pay a different value of $5, and you're going to pay more than $5. However, also, that would be because your extrinsic value is positive and it adds to the value spread. So let's say the spread was, it could be trading at like theoretically $7. So you could be paying the $7. Intrinsically, it would be $5. Extrinsically, it would be worth $2. It's $2 of time value. If it was trading up closer to the ceiling, maybe at 1980, you're going to pay, it would be worth, let's see, the floor price is 1955, 1980 minus 1955 is what? Somebody help me on my math. 25? So intrinsically it would be worth 25. Now, interesting thing is if we're along maybe with 90 minutes to expiration, you're going to pay less than that. Extrinsic value is negative. That's where you can actually capture the time value. And we'll get into that also in future webinars. So your intrinsic value is always going to be positive if it is anywhere in the money. Your extrinsic value can be positive, it can be 0, or it could be negative. Intrinsic value for a short spread is calculated by determining how much the underlying is below the ceiling price of the spread. If the underlying is not trading below the ceiling, then the short spread does not have any intrinsic value. The maximum intrinsic value is capped by the floor price. So the maximum intrinsic value is always the difference between the floor and the ceiling price. For example, when the US 500 is trading at 1920, a US 500 1900 1940 spread has an intrinsic value of 20. Why? Because it is $20 below the ceiling price. Ceiling price is 1940, underlying is trading 1920. Intrinsically, the spread would be worth 20. The maximum intrinsic value of the spread would be 40. And how do you do that? You take the difference between the ceiling and the floor price, 1940 minus 1900. That gives us the maximum intrinsic value of the spread. It's just the opposite of what we went over for the long spread. Here's how you see it graphically. So we're trading at 1920. We're $20 below the 1940 ceiling price. That is the intrinsic value of the spread. Again, in this example, it would be trading at what we call the null point. Extrinsic value. So extrinsic value is the other component that makes up the Nadex spread premium. All spreads until they expire have extrinsic value, unlike intrinsic value, which out of the money spreads do not have. And this is almost a true statement. All spreads in the money have extrinsic value. However, there's a point called the null point where it crosses an axis where extrinsic value is technically 0. Many people use the terms extrinsic value and time value interchangeably. However, this is not completely true. There are three main components that make up the extrinsic value. So, the extrinsic value is made up of the time until spread expires, which is, if anybody knows the Greeks, it's the theta component. Theta is your time decay, and your actually time can work for or against you depending on where you have the spread on and if you're long or short. You also have volatility. It's technically implied volatility. Both time and implied volatility are inputs into an option pricing model, and since these spreads are made up of options, they're inputs into the Nadex spread pricing models. So those are the two main components. There's also interest rates that go in there, and interest rates, you're trading these intraday, and interest rates hardly have any effect on the spread price, so we're going to ignore that. Just for the point of completeness, know that the risk-free interest rate is a component into an option pricing model. So the extrinsic value people call time value is really time and volatility from our standpoint. So the two major components that I just said are time value and volatility. The more time left in the spread, the higher the premium will be. For example, a spread that has 8 hours left will have a higher time value than a spread when only 1 hour is left. There's more time value in the spread with 8 hours than 1 hour, so it's going to have a larger effect on the extrinsic value. And it can make it either more positive or more negative. This time value is known as theta. The higher the implied volatility, the higher the premium will be also. The volatility component is referred to as vega. Vega can change throughout the trading day, and it's not necessarily based off the true volatility of the underlying. Okay, it can also be based off the expectations of future volatility versus how it is now. The higher the vega, the higher the premium, both positive and negative. For example, crude oil with an implied volatility of 30% will have a higher spread premium than an implied volatility of 15% with all other factors being equal. And what I mean is, when I talk about implied volatility, is based off the future sort of belief of what will happen to volatility. For example, if you're going into a major report or a major announcement, the underlying might trade very quietly, might not trade in a big range, but implied volatility could be very high, even though actual volatility of, let's say, crude oil going into an oil inventories report, the actual volatility could be very low, meaning it's not trading much because everybody's waiting for that report to come out. The implied volatility, however, would be really high because that's an input into the option market maker's model, and they're going to say, well, once this report hits, this market's going to get really volatile. So if I'm going to essentially sell these spreads or sell these options or buy them, whatever, I need to base it off of how I expect the market's going to behave when this report comes out, not necessarily how it's going to behave now. So that's why they're going to change the implied volatility in their option models. Also, market might be really, really busy. For example, when the futures markets, like the S&P 500 opens, generally it's really busy the first hour, hour and a half of trading. You start going into lunch, well, it's probably going to quiet down unless it's a very strange day. Well, if I'm the option market maker, it might be busy now, but if I'm selling a spread that is going to expire during the lunchtime period, I might start adjusting my implied volatility down lower as we get closer and closer to lunchtime, because I expect the trading conditions to get quieter and there not to be as much volatility in it. So it's, just to reiterate one more time, it's not just based off how volatile the market is now, it's based off of expectations of how volatile it will be during the period that spread could be on. All right, I've talked about the null point a couple times. There's a special point in Nadex spreads where the spread is in the money and there isn't any extrinsic value. There's only intrinsic value. We're going to call that point the null point, referring to the fact that there is not any extrinsic value. This point is the middle point of the spread, halfway in between the floor and the ceiling. Here is the null point. I have it circled. You can see that this is what this graph is showing the price of the spread, okay, with 60 minutes to go, 30 minutes to go, 10 minutes to go, 5 minutes to go, and an expiration at a given implied volatility. Let's just call the implied volatility 25%. So you can see when all these lines cross this axis, which is right in the middle, this is a 100-105 spread, a hypothetical 100-105 spread. Doesn't matter what market it's in. Right in the middle, which is 102.5, no matter what time there is to expiration, they all cross. Now, as we just went over, if it's trading 102.5, which is right in the middle, intrinsically it would be worth $2.50. And if you were to put it on at its theoretical value, you could get it on at $2.50. Yeah, we know there's bid and offers, but they're going to be on either side of it. Theoretically, it's worth $2.50. There is no extrinsic value. What I alluded to earlier with extrinsic value being positive and negative, and we'll get into this more in future webinars, but I'll give you a little preview right now. Let's say we're trading at 105, and I wanted to put this spread on with 60 minutes to go. Theoretically, it's intrinsically on expiration. If the market doesn't move, it's eventually going to be worth that full $5. However, with 60 minutes to go, it's only worth about $3.20. Well, why is it worth less? Because Extrinsically, remember I said there were two components. Intrinsically, it's worth 5. It's only trading at $3.20. That means the extrinsic value is negative. It's negative 180. Okay? If the market just sits here, let's just say it goes really quiet and just trades on either side of 105 and eventually expires at 105, that spread's going to be worth its full $5. But the trader who has it on here is going to collect the time decay, assuming volatility doesn't change either. All right, so over time, see if it just sits here. 30 minutes ago, they've made some money. 10 minutes ago, they've made some more. 5 minutes ago, they made some more. Expiration, they've made the full value. If we're down here at the money, concept Bob went over earlier, right at the money for this spread, 100-105 spread, let's say we're going long at the money, we'd be going long at the $100. Well, with 60 minutes to go, it's intrinsically worth 0, but we're going to have to pay something for this spread. Let's call it we're paying $1.80. If we go up and over, we can see it's about $1.80. Intrinsically it's worth 0. Extrinsically it's worth that 180, that time value or that time and volatility value. If this underlying does not move and time is working against us, with 30 minutes to go, if it's still trading at 100, the spread's only worth about $1.50. 10 minutes to go, it might be worth $1.10. 5 minutes to go, it might be worth 80 cents. No minutes to go, expiration, it's worth 0. So therefore, time is working against us. That is an example of theta, or time decay. Up here it worked for us if we were long. Down here it worked against us. If we were long in the middle, we have no extrinsic value, therefore we have no time decay. Don't worry if you don't understand all these concepts right now. I'm just giving some people a preview, and we'll get into this more and more as we get into the Greeks and how everything like volatility, time, the price, the underlying, how all these fit into the option models and the Nadex pricing model, and how like the movement of the underlying, how much it changes the spread price, which is a concept called delta. And I've already alluded to theta, which was a time decay, and how implied volatility changes the spread price, which is, again, vega. Those are the kind of things we're going to be going over in the next couple weeks. So here is a premium calculation decision tree, and if any of you want this, you can come to our website and register for this and get this for free. It's just to help people understand the spread premium and the components, if it's intrinsic or extrinsic, and to sort of go through the decision tree. So you start here, are you long or short? If you're long, you follow the long arrow, and then you answer the questions, and it gives you the answer, how to determine your premium calculation, if it's intrinsic or extrinsic, or both. Turn this back over to Bob real quick, and he'll wrap it up.
So in this webinar, we covered the concept of moneyness and how to know if a spread's in the money, at the money, or out of the money. This naturally leads into the concept of spread premium and intrinsic value and extrinsic value. We looked at how to determine both intrinsic value and extrinsic value and the components that make up extrinsic value, very important part. We also looked at the null point of Nadex spreads, where a spread is in the money but does not have any extrinsic value. Most people don't know that spot even exists. So tune in next time, because we briefly touched on theta, time value, and vega as it relates to the concept of extrinsic value. And in the next webinar, we'll examine all the Greeks as related to Nadex spreads. We'll go in depth into delta, gamma, theta, and vega and see how they affect spread pricing, because knowing these concepts is important to understanding how and when to trade the different durations and ranges of Nadex spreads. These are not just, I think it's going higher and I don't want my profit limited to $100. That's not just what these are. Again, these are vertical debit spreads, and knowing all the little nuances of the premium, of the pricing, is extremely important, because there's times where you want to put certain ones on, there's times when you don't. There's circumstances where you want to put some of them on, and there's circumstances where you don't. So as Mike said, go to our website. You can get that free decision tree. Follow us on @path_trading and like us on Facebook. And most important to me, check out our podcast, The Money Path, which we talk about everything, not just Nadex products, but equities, futures, commodities, and a bunch of stupid stuff. So check that out. I promised you guys I'd show you this, and I'm going to real quick. This is where you find it. Okay, this is Nadex's cool new website. So if you're at the home page and you want to look at 1 through 3, or 1 to 2 rather, you go to the Learning Center, you go to Webinar Archives, and all the archives are up there for everybody that does the webinars. You can just find our logo, watch the Nadex spreads in their construct, and then part 2 is up here, and then part 3 will be up here in a couple of days. So check those out, and we are happy to stick around for any questions. What's the website to visit, sir? It is pathtradingpartners.com. It's right there on your screen right now. pathtradingpartners.com. You're welcome, Eric. So go to that website. There's a bunch of free stuff for you guys to look at. There's some paid-for courses as well, but there's plenty of free stuff for people who are a little short. Just go ahead and check out the free stuff and just join us, because we'll have stuff coming out soon that'll be really, really helpful to your trading that you guys are going to be interested in. But I don't like to turn this stuff into a commercial. So what else, guys? If there's any other questions, please shoot them in now. We're happy to stick around and answer them. Otherwise, we have no reason at all to take up any more of your time or any more of Nadex's time. Again, we want to thank Nadex for allowing us to speak to you guys. Always a pleasure doing these webinars. We enjoy them as much as you enjoy signing up and hearing me drone on. So I'm not seeing any more questions. We'll call it a night. If I missed a question, if you were typing one, just send it off to us. pathtradingpartners.com has a support email. You can send questions there, or you can send them to Nadex and they'll get them to us. Thanks again, guys, for being here. Cheers. We'll talk to you next week. Same time next week. Tuesday, 4 o'clock Central, 5 o'clock Eastern. Cheers, guys.